barely 24 hours ago, Kenya tapped international credit markets to raise $1 billion in a 12-year dollar-denominated Eurobond. Now, that particular note will be repaid, as we understand it, in two tranches in January 2023 and January 2034. The note got a yield of 6.3%. Now, this was the first such issuance from the East African tea and coffee exporter in 2 years, and it attracted over $5 billion in offers, which the country's finance ministry argued was a sign of strong global investor confidence. We'll explore if that's the case in just a moment. Now, despite repeated statements of intent to lower its fiscal deficit and decelerate the growth in public debt, the country has repeatedly failed to meet either goal. The fiscal deficit, for example, has remained well over 7% since 2016. And these two trends partially explain why Kenya's debt service costs in the fiscal year starting in July will go up by over 20% to nearly $11 billion. Now, a few hours ago, I spoke to Gibran Qureshi. He's the head of the Africa Research Desk at Standard Bank. I started our conversation by exploring how that 6.3% yield compares to other Eurobonds of a similar tenor from across Africa.
I think that's fairly good pricing, especially when you look at it in the context of other similar rated credits like Egypt, that has a 31, 32 tenor, and Ghana as well. I think Kenya has got favorable pricing with regards to those metrics or comparisons. If you look at Côte d'Ivoire, however, which is a story people still like fundamentally, despite some of the political concerns, their 12-year is priced in the low 5%. So Kenya, comparatively to Côte d'Ivoire, didn't get great pricing, but I'd argue that in comparison to the likes of Egypt, Ghana, and even having this investor meeting a day after the Fed, it's overall very favorable pricing.
Okay, but looking at the bids that came in, we had $5.4 billion in bids for this one. We've seen much larger bids coming through for previous offerings. Given the fact that we have at least $10 billion in debt service due in the next fiscal year, the one that starts on the 1st of July, did we leave money on the table?
One could argue yes, especially given that, if the Federal Reserve is behind the curve with regards to inflation being transitory, and if it isn't actually transient, then of course the expected rate hikes that have been penciled in from 2023 could be brought forward in subsequent FOMC meetings for this year. So when you look at it in that context, then the argument is that perhaps Kenya should have taken a bit more now to use some for new money and perhaps some for liability management. But I think authorities do still expect to issue another Eurobond in the first half of this fiscal year, which is the second half of this calendar year. And I think a lot of those proceeds will go towards liability management, potentially to pay off or retire partially some of the expensive syndicated loans that the Kenyan government has contracted between the best part of 2016 and 2019. But overall, I would think that there's so much global liquidity that's chasing yield. I don't think that whether you come in June or whether you come in September, that there will be a significantly different sway in propensity or appetite for sovereign yield in Africa.
Indeed, and I think you sort of alluded to my next question, because looking at the statement that came out of Treasury yesterday, they were saying that 5 times oversubscription, and I'm quoting Treasury here, was a sign of strong global investor confidence. But isn't this just a function of, chasing yield? Because there's a lot of liquidity out there that has fairly grim options. Greek 10-year notes, Greece of all countries, 0.8%. US 10-year notes, 1.5%. So if someone comes along and says, look, I will borrow for 12 years, I'll give you 6% on this money, obviously you're going to get a ton of traffic. This is just a yield play, isn't it?
Absolutely. I think you are correct. With regards to the monetary largesse with, broadly accommodative policy, the consensus is that it will persist for 1 year at least. And, the contrarian or counter argument to that is that, as I said earlier, if the Fed's behind the curve on inflation and rates have to be raised earlier to counter this spike in inflation expectations that we are seeing, then of course that could make liquidity a bit more scarce than it is right now. But I think comparatively speaking, as I said before, I don't think it will dry up the taps completely to make it dramatically expensive or not possible at all for any African sovereign to tap the Eurobond markets in the next 6 months or in the next 1 year.
But why is that faith there? Because the Kenyan government has been talking about consolidating public finances, bringing the deficit under control, bringing debt under control for the better part of, I believe, 5-6 years now, and they really haven't gotten a handle in it. Year after year, we just see blockbuster deficits, and our debt mountain just becomes bigger and bigger and bigger. So I guess looking at it from an investor's perspective, the question is, given the fact that this government says one thing and then does the complete opposite, why still invest in Kenyan debt?
A valid question, Rama, indeed. And I think, as you mentioned, I agree with you that, the Kenyan, from a credibility perspective, the fiscal deficit has just not come down since 2017, 2018, and was even elevated prior to that as well. I think, in an environment where certain, funds have to take African risk, they're not going to ignore the Kenyan economy when they come to issue Eurobond, for starters. But as I mentioned, and I still maintain, there is some element, and I'm not saying it's correct, but there is some element of a bit more credibility with the IMF coming back to town. If you think that the Kenyan government wouldn't lower its budget deficit and restore debt on a sustainable path without the IMF, I would give you that. But I guess the investment community believes that with the IMF and that added anchor of credibility, there's a better chance of the Kenyan government lowering its deficit.